Hello, everyone. This is Jordan. Welcome back to the Daily Gold YouTube channel. Thank you so much for tuning in. This edition of Macro Mondays is being recorded on the early evening of Monday, March 3rd, 2025. Again, thank you so much for joining me. And in this rather brief video, I hope, are we about to come into the perfect macro setup for gold and silver? Well, maybe we are. I'll discuss in the video and then you can decide. Let's get to it. So we have some pieces of information that came out in recent days. Well, mainly this, the GDP now, the Atlanta Fed estimate of GDP for this quarter. If you follow this, it tends to be pretty volatile, I would say, week to week or definitely month to month. So this can be volatile. Roughly a month ago, this was up to 4% as far as an estimate. Now it's way down nearly minus 3%. So that is quite the change in 5 weeks. But remember, for a recession, it's not just one quarter of negative growth. You need 2 quarters of negative growth. And on top of that, you need the key economic indicators to all roll over. If you go back to 2022, yes, based on GDP growth, it was a recession. But why did they not deem that a recession? Well, if you look at the 4 factors like production, consumption, investment, those types of things, they did not roll over with the headline number rolling over. So you can, debate that amongst yourselves. But that's what I'm just pointing out. Not only do we need 2 quarters of negative growth, we need 2 consecutive quarters of those economic indicators all rolling over. So enough of that from me. This is probably a better real-time indicator than GDP now. So this is from, I think the site is Kalshi. Yeah, Kalshi. And so this is the betting market prediction site. And so this thing has popped up quite a bit in the last week. So up to 37%. With these types of indicators, I think by the time this thing gets to, who knows, I'm just guessing, by the time it gets above 75, 80%, you're probably going to have a recession. But it's the same thing with those other indicators. You've seen those other indicators from the Fed and such. By the time you're actually going to have a recession, you're nearly in a recession, and the percent chances from all these, they tend to be really, really high. So just because it's at 38% now, that doesn't mean it's safe. Again, by the time this and other indicators are above 75, 80%, you're going to have a recession. And at that point, it's probably baked into the market. But anyway, just enough of me babbling. This is where we are now. Recession fears are really starting to pick up. And it makes sense considering cutting government spending. That's a good thing in the long term. But in the short term, in the present, I should say, that equates to lower growth as far as GDP. I think the tariffs will probably have a much bigger effect. I think that's what the market's worried about. So that's where we are with the economy. As I'm not an economist, and look, forecasting macro is extremely difficult. There's very few people who can do it. I tend to focus more on companies now in gold and silver. So I'm just pointing that out before I get into talking about the economy a little bit. One way we can assess is by looking at various macro market indicators. The yield curve, the 10-year minus the 2-year. You can also look at the 10-year minus the 3-month. Gold against the S&P. We have the 10-year yield here. Also the real 10-year yield and the S&P 500. And I've mentioned this in past videos, but it's the yield curve, and it's the yield curve going inverted, going below this zero line, and then popping back up, but popping back up significantly, like we saw here. That's a significant move. That's a significant move. This is a significant move here. Now, in the late 90s, this was not a significant move. So if the yield curve de-inverts or uninverts, and then it meanders like it did here in the late 90s, that means no recession. So we'll see. Maybe this thing will meander for a little while, but if it moves up like that, that's going to be your strongest macro market signal of a recession. And interestingly, gold against the stock market, I've talked about this numerous times. When you get a steepening yield curve, you get the inversion that it steepens and you get a recession as noted here. And here, although it was really COVID that put the economy in a recession, it was coming anyway. That steepening and that move aligns with gold outperforming the stock market. I mean, it was much bigger here when you had these full-blown recessions. I mean, remember, COVID was brief. It was a shock. But look at where we are now. Gold against the S&P 500. This is a 4.5-year base. And today it closed at 0.50, right on this resistance. I think this is weekly data. So this is right on the cusp of making a significant move. So again, if this baby is going to go like that and you get more steepening in the curve, you're going to see this shoot up. And these two things would indicate a recession. I mean, there's no way we're going to see those things happen without a recession coming. Either it's imminent or a couple months after the fact. Now, in addition to that, take a look at, this is the nominal 10-year yield here. This is the real 10-year yield. If you read my book, you know that the best indicator historically for gold is the inverse, the direction, the inverse of the real 10-year yield. And I mean, both the nominal 10-year yield here and the real, this is setting up. I'm not predicting this is going to go back and we're going to have deflation, or maybe we'll have a whiff of deflation. But there are setups here for these things to break down here and plummet. Now, very big picture, in a secular sense, the bond market is in a secular bear, but it's been so extremely oversold. I mean, this has been a record move in a short amount of time. So this is getting digested. The market's going to go the other way. It looks like we're probably going to get a good bond rally. And again, this thing breaks down, and the 2-year yield, the short term, that would have to come down a lot faster than this. I apologize. I should have put that on here, the 2-year yield, which the Fed funds follows. But I'm babbling on here, droning on. But this is recessionary. I mean, you get a big breakdown like that, and here as well, that's recessionary. And again, that's confirmed by a move like that. So that's kind of my macro market take. Now, moving on, let's talk about gold a little bit and why the setup is so bullish and so ripe for gold. Well, in a recession, that leads to lower real interest rates, as we just saw. It leads to Fed cuts and probably some fiscal stimmy as well. And the timing of this is really crucial. That's what we have to understand. Based on gold against a 60-40 portfolio, gold against the stock market, the timing is it's set up for a beautiful move in precious metals. Look, gold is just getting close to breaking out of this 10-year base against a 60-40 portfolio. Gold against the stock market. Again, this is like a 4.5-year base here. This is setting up. So if this baby breaks out like that, this thing is going to shoot higher. Even though bonds are going to rally, remember, gold against the S&P is 60% of this. So gold has been stabilizing, moving up, but that's just because it's been outperforming 40%. Now, even though that 40% is going to have a big rally now and come out of the toilet, this can still shoot significantly higher because gold can crush the 60%. And so the timing of this, it's just really set up for a huge move in gold. I mean, that's another video. I could talk more about the technical side. But it's important to understand the macro that is setting up, plus this chart and what can happen. You have the right macro, and so capital will move out of the stock market and into gold, and then that'll filter down into the rest of precious metals. And this is another thing, just extremely important to understand. This chart from Callum Thomas, I'm a subscriber to his top-down gold charts publication. And look, this is gold against the 60-40 right here. Look at how closely this mirrors the ETF allocation of gold ETFs against all ETFs. But this is where we are. So this has a lot of room to move up. I mean, if this, what is this, 1.5% right now? What if this goes back to just the COVID level of 3%? I mean, what if it just doubles? That could take gold to 5,000. That's not going to take gold to 3,500. That's going to take gold to 5,000. So I know I didn't talk about the economy a whole lot in this edition of Macro Mondays, but it's important to understand if we have a recession, that is the perfect scenario for gold and then silver. Because if we look at the technical setup, gold is ripe to break out of a 10-year base against the 60-40 and out of a 4.5-year base against the stock market. So capital, a recession is going to push even more capital. I shouldn't say even more capital. It's going to push way more capital into gold and secondarily silver and the rest of precious metals. So the setup is there. The time is really ripe for gold. I know that I think we're in a short-term correction. Maybe it's a medium-term correction. But if we look at the 30,000-foot view, we have to understand that there's real potential over the next 12 months to have an accelerated move to the upside. Again, I don't think it's coming in the next month or two, but I think the odds of it coming, or at least starting at some point in the next few months, are very high. So that's all for this video. Let me know what you think. Thank you so much for tuning in. Hope you have a great week ahead, and I'll talk to you guys again in the next video, which might be an interview with Professor Vince Lancy, wrapping up the month of February in gold and silver. Leave a comment about that. Let me know what we should talk about. Thanks, guys.